Well, welcome back, everyone. It's great to have you here. Mike Fairborn here for Generating Income in Your Portfolio class. I do love to go through each and every week where we do look at dividend-paying stocks. Folks, today I wanted to really talk about the concept and the process of really going through and building out a dividend ladder. And that is really the ladder being really a potential income strategy for generating potential income month to month to month. To do this, we'll look at both growth and value concepts through the eyes of a trader and what they might be looking at specifically in terms of stock selection for this dividend ladder. I've actually built for our class today and something I want to share with each of you, but it is a script, a think script specifically that focuses in on cash flow relative to prices. Remember, we talked about this the last few weeks, the importance of cash flow to paying those dividends, to increasing the dividends over time. I hadn't seen one ever been developed, so I'm happy to share that with you today. I was looking for one. I just put some time in and to get one for our class. So I've got that up and going. Looking forward to sharing that with you and hoping you find some value out of it. You should. All right. Well, I'd like to welcome everybody. I'm welcoming into my good friend James Boyd. You'll see him in the chat as JB. Many of you are familiar with James and his classes. Does a great job. Very knowledgeable instructor. Folks, any questions, comments you have, throw those into the chat box so we can try to address those for you. And just welcome to all of you. It's great to see you all back. We've got Sim, Rishna. We've got others in here. BJ, welcome, all of you. Kevin, how are you? SJS, photography. David, and others. Rocky Raccoon, welcome all. Yeah, use that with any questions, comments, any sort of topic requests as well. Those are always welcome too. So with that, let's dive into some disclosures to get the show on the road here. But I wanted to state a few different points as we look at this today. The paper money application is for educational purposes only. A successful virtual trading during one time period does not guarantee successful investing of actual funds during a later time period, as market conditions change constantly. Information here is for general information purposes only and should not be considered an individualized recommendation or endorsement, really, of any particular security chart pattern or investment strategy. Please keep all that in mind. Investing does involve risk, including the loss of principal, and past performance of any security strategy does not guarantee future results or success. Now, a key disclosure, obviously, for our discussion today is the fact that there are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends altogether. We can't miss that one because that is what our class is really all about. A quick note too, if we do touch on it a little bit, but risks of REITs are similar to those associated with direct ownership of real estate. Now, a quick slide here just before we dive into it really quickly here. Dividends. We talk about dividends in this class, but we have addressed dividend type other areas and different segments of dividend payers, for example, in REITs. We have brought options in from time to time, and we do we've had some discussions on fixed income, and I'm sure we'll have more down the road along with options too. But today, again, really just a key focus in on the cash dividends. We've yet to do one on stock dividends, although stock dividends can be interesting, and we will do that down the road for sure. That'll be an interesting discussion as we go through and look at stock dividends at some time. But really, much of our discussion today is going to be on the cash dividends, of course, and really talking about the importance of, for some folks that want to replace income, for example, that they may have lost or whatever the case might be, but a dividend ladder. Trying to build that consistent stream, a month-to-month income stream of potential dividend payments, as long as those companies continue to pay those dividends. Okay, well, let's get started. Let's start off here first with the S&P 500 index. A quick note, big recovery today in the markets. Just wanted to show you that, James brought up an interesting point earlier because I do chat in his class. He does chat in mine. Of course, I think he was subbing in that class. But a quick note I wanted to point out that James had mentioned, and that is this, that the VIX has had its biggest decline, its biggest 4-day decline, I'll just say it, ever. Now, tell me if that's wrong, James, but I thought that's what it was, the biggest 4-day decline ever on the VIX. And so interesting to see volatility dip. Of course, that can go a long way to fueling the markets. It's why it has. There's an inverse relationship with the VIX and the market there. Market prices up, VIX down, and vice versa. Generally what we'll see there. But a good solid day performance in the market and looking for some of the dividend payers. By the way, a quick note here too. We brought this point up. I'm going to just show you the S&P 500 sector over here. I do like to have this description box. I do find it effective because, folks, I don't know about you, but I have not invested the time yet to memorizing these symbols. Now they're in five 5-point increments. But yeah, anyhow, I just noticed that. But put through the description column in here, very, very helpful. A couple of quick notes that I just wanted to highlight here for you. Energy stocks have made a higher high, for example, over here, and a higher low in terms of the possibility of a longer term trend continuation, maybe a double bottom down here. It does remain to be seen. We'll have to see what does happen with oil specifically. One other area that we are seeing, and by the way, energy can be a late stage sector. A lot of those industries in there that will run late stage with late stage economic growth. Not to say that there will be a recession, but they do tend to be late stage, and we've been seeing some strength maybe come in to that area in some of the stocks. Also, in terms of sector rotation going back into value, and guess what? That includes dividend stocks as well. Over here, healthcare, breaking highs. We have the healthcare sector strong. Now, why do we look at the healthcare sector? A lot of times when the healthcare sector is strong, it's a reflection of underlying, it's too long of a word. I'll just say F, fundamentals. Underlying fundamentals can get a whole sector going higher, and that can, all else being equal, be helpful for the STK, the stock, to potentially within these groups to maybe have a little bit of a boost. You can get some of that strength with the sector, and that's what we're seeing right here. But that clearly is a break above. I know many of you do look at your technicals. This is a higher high, and that right there is a break and holding its support, and then we're on the verge of maybe taking out more highs, which is what happens, when the trend ticks up a little bit. So keep that in mind. Okay, with all that being said, we're going to dive on into a couple of different areas. Now, what I wanted to do, because we are going to look at healthcare, and it's going to come up in our group, I'm going to, first of all, explain the dividend ladder. And what I want to do is I'm going to use actually just this chart. This would be just fine to use. In fact, I'm going to go like this and just kind of make this price almost irrelevant, just really kind of squish it down. I'm going to take off these indicators below, and I'm just going to use this as a visual in terms of the calendar below, but a calendar that we can see going from left to right. Oh, okay, let's do that again. There we go. That's interesting. It does a reset. Didn't really know that, but if you take out the indicators, it resets it. Okay, I'm just trying to take out price action and just kind of highlight this point right now as we get into it. All right, so looking over here, when we're looking at a dividend ladder, and we're going to do the stock selection into that dividend ladder in just a moment. We'll get into that custom built ThinkScript indicator that I built just for you guys here momentarily. But let's talk about a ladder itself. The ladder really represents consistent income over time. And when we say time, when are dividends paid? Well, they land in a given month, whatever the case might be. They land within a month's time frame, right? They're just, you might get one in October, November, whatever. I'm talking about the dividend payments themselves. So to get a steady stream, a ladder of income, in other words, every single month, whatever month we're looking at, we're going to be seeing income coming through on that month. And that income each and every month is going to extend all the way through the end of the year. Now, that's going to extend as long as I mentioned. I mean, it's set to extend. We're looking at companies that do pay consistent dividends over that time frame. Of course, they could stop paying dividends. That does happen from time to time. In fact, with the dividend aristocrats, we lost 2 last year. The aristocrats are, again, remember, those were those companies that raised the dividend 25 years in a row, every single year. Come rain or shine, they raised the dividends. Well, last year we lost from that list, if you remember, 3M, MMM, and then also WBA, Walgreens, which is fascinating. Remember that over time, but those two got knocked out. Let's give it a red line, justify that, out of the dividend aristocrats. So there were about 68. I think they were added a couple, but my point is we're looking at companies that have a history as well of increasing the dividend. It doesn't mean it can't be cut, but there is that history there. By the way, 3M, it was due to that lawsuit they were losing and the payouts they had to pay on it. All right. Well, the interesting thing here is at the bare minimum to create a dividend ladder, again, given the fact that the expectation, I should say, that those dividends are going to be increased, they're going to keep paying the dividends consistently. For US companies, those are paid on a quarterly basis, meaning every 3 months. And so by definition, we would need at least a minimum of 3 companies. That's a minimum. That's what it means. Minimum of 3 companies. We're looking, let me just look at the last recent bit of data. That means we'd want to have one that paid dividends in June. That'd be our one company. We'd have another company that paid dividends in July. And then we'd have another company that paid dividends finally in August. Now, what would happen over here is by the time we got to September, well, the one in June, it would be, 1 to 3 months later, we would come back up and we would see number one, this same company, whatever company that is, they would continue to pay dividends again. And folks, that would extend, I guess I have to pull it over here. You would get over here, then you would get 2 and 3, and it would start over with 1, right? And we would have 4 quarters in a year, so each one of these would pay dividends a grand total of 4 times, okay? The whole idea, though, is keeping that dividend consistent. If you've ever heard the term dividend ladder, that's what it is. So enough said there. By the way, just to reset this, go up top here, just click on auto, boom, we're right back to where we were. All right, so a quick look down at questions. Looks like JB's got us covered here. Yes, okay, so SJS says staggered dividends are good. Somebody pay in the same month. Yeah, so, that can be something in addition, right? SJS, of course, you'd want to find those companies that meet the parameters that we're after, and we want to go through that specifically. So we're going to do that. We're actually going to dive in and take a look at growth, et cetera. And by the way, one way to do this, which is really cool, is I'm going to go take us right into Schwab.com. Where are you? Well, I had it here just a second ago. There it is. Okay, so let's pull it up. And I'm just on Schwab.com, and all I've done is simply gone into research up top here, and then right into research tools. And under those research tools, I just want to go to Stock Screener. So originally Schwab.com, research tools, Stock Screener, and you've got this here. Now I did create a fake. We don't have like a list that just looks for dividend aristocrats by themselves, but this tries to find those dividends specifically. It looks for them. So it tries to highlight them. And then what we're going to do is we're going to use this. I'll show you what it looks like. And we're going to add a little feature in here to help us spot maybe some of these companies that we could put into a dividend ladder based upon both aspects of growth and value. We like to see companies growing. Growth is really important a lot of times for the value of a stock over time and the underlying stock trend. All else equal, right? It can increase the value over time. Now, value is important because sometimes the growth has gone all the way up here that any little miss on earnings, I'm sorry to say this, but I've been involved in a few of these where earnings have been bad and it gaps down here because it's priced to perfection. You might have heard that term before. That's based upon growth. It can push stocks up really high. So really when you get a combination, we're looking at value, so we're not so high up on the valuation trend, so to speak. Maybe it's a little bit higher. And with that, a lot of times if there's value, what a company's value, do you think? Any thoughts on that? If you've got a stock that's considered value, in other words, the price hasn't run up too high, what else do you get when we're looking at dividend type stocks? Do you get a higher dividend yield or a lower dividend yield? And we like all else equal, the higher. But if prices haven't gone up as much, we would likely get the what? The higher dividend yield as well. So you get sort of a double benefit here. I'm just going to put 2 pluses, potentially a double benefit. If you can find something that's got characteristics of growth, but it's not run up so high that there's still value there, and then boom, boom, the dividend for the next potential positive, the dividend yield is also higher too. Therefore, we could potentially wait longer for the trend as you're getting paid a higher dividend. But that's the value of incorporating a better valuation, basically. You know, a lot of the famous analysts and fundamentalists have spoken a lot about value and the importance. Everybody likes a company and they like the growth of a stock, but they don't like to buy too high. Because I think it was Charlie Munger that said, he passed away last year, I believe, but he said that there are a lot of fantastic companies out there. And he named them, but he says, I just can't own them as a shareholder because they just are too expensive. And that makes sense, right? Because they're great companies, but if they don't have growth potential in that share price, then how valuable are they for us? When we buy, prices in the stock price needs to go higher. It needs to go up in order for it to be valuable for us. Now, it could go sideways if it's got a good dividend yield, but we're kind of looking at combinations of both here today. So let's do this. And by the way, I'm just going to show you what this search is. It's really great on Schwab.com because you can save this too. You can save these searches. I've got 126 matches. We're certainly going to narrow this down, but I want to show you, just highlight real quick so you know why it is these companies are coming up as we do a search here for growth and value characteristics. Okay. So next, what we have here, they're all, first of all, in the S&P 500. They all have dividend yields of greater than 2%. So 2% plus, 2% or plus 2+%. We've got the S&P 500, so they might be somewhat established. I've got prices between 20 and 850. Have they increased dividends over the last year? Yes, we have that selected. We do have that. Yeah, the increases. Oh, by the way, you get this one here, it dipped. So notice over here, I just noticed it says none. So I must have saved it as none. I'm going to show you how to adjust that. But then I've also got the 10-year dividend growth rate. So you can see it visually showing and proving to us that, yes, they're like aristocrats. This is not a dividend aristocrat search. Many of these are dividend aristocrats, but they've been raising over 10 years. And now I've got over here an estimated earnings per share growth rate. Boom, there it is. Growth. You'll notice I don't have value yet. We've got to add one more item. Let me quickly just adjust this so you can see how I do it. Anytime you want to change anything you've got up here, just click on the bar. So simple. As soon as that little cursor highlights, change it. Remember, mine says none. I do want to say increasing. Boom. I just knocked off several right there. Now we're down to 111. Notice every one of these now is increasing dividends. Now I selected that over here. This was a selection that was right from dividends right there. You can click on that, you'd find it there. Importantly, though, the one I really wanted to hit is valuation. There is a great indicator out here. I know many of you have seen it. It is helpful. It can be helpful for finding it because I say it's great because it, no indicator is perfect, but this is helpful because it can go blank screen here. It can give us an indication of growth and value because it's neat because it looks at both the PE ratio as the numerator. Okay, that's the PE ratio, but then it also has projected growth, projected earnings per share. I'll just put projected. No, it's not prog, is it? It's projected. Let's use the eraser. There we go. It's projected growth. Right there. Okay, so growth, and that growth specifically is around earnings growth. Okay, so I'm just going to say of earnings there. And we're comparing the two together. If you look at companies on a PEG ratio that are less than 1, if that's what this gives us, if the PEG ratio, and you can see where the PEG comes in, we don't have this on Thinkorswim, but we have it in Schwab.com, which is just fantastic. That's the PEG ratio. If that equals, less than 1 or less, that tells us that basically the PE ratio of the company is actually lower than the projected growth rate itself. I'm going to stop and just hit that again because I don't know, many of you might have caught this, but that is an explanation of value right there. The PE ratio, what people are paying for the price relative to earnings of a company, is less than. If we're in this category, the PE ratio is actually even less than the projected growth rate of earnings. By definition, it's kind of a value proposition, isn't it, in terms of the formula? We have that ability to look at these companies so we can kind of get that growth characteristic in here. It's right here. It's right over here. There it is. There we go. Okay, so let's add it in right at the very bottom. Price, there it is. So it's actually, yeah, price earnings, it's price to earnings ratio divided by growth. But that growth is a projected growth number. So in other words, there's an anticipation of growth going forward as well. I'm going to choose less than 1 just to show you. Whoa, there it is. We get 8. That's it. We only have 8 here. You recognize some of these names? Would any of you thought that the growth rate of, for example, Merck is actually 0.25? I mean, it's really quite low. In other words, the PE ratio of Merck is so low relative. I mean, it's much lower relative to the growth, the projected growth. It's not a guaranteed growth, but the projected growth of the company. Earnings per share estimated for next year, 21%. That's why I like having this on here. It's really kind of a cool tool. They've been growing at 5%. I think more recently they've been growing the dividend rate at 5%, and increasing dividends. Yes, 5.71%. It's really kind of been spiking up a little bit, hasn't it? The dividend yield, it's over 2.5%. Okay, that is one we can look at right now, and let's mark this down and kind of look at it. But notice a key point. Do we have combinations, folks, here of growth and value? Honestly, that PEG ratio does it for us. That's what makes it so interesting. So price to earnings, it's a PE ratio, actually like this. It's PE divided by growth is what that looks like, projected growth. But you see it up there. It's just right there. Get the same formula. Okay, so we've got that one. Well, let's take a look at Merck right now, just on the chart. We'll get this back. So MRK, and there you go. Now, Merck did dip a little bit recently, but projections are still for growth. So you can see that they did actually beat earnings. I think something got pushed back, but even with the pushback, there's still some growth potential. And it is interesting. You are getting, even on a longer term chart, this is a 5-year weekly chart. I know James and I both like to look at these longer term charts, but you can see that prior highs, longer term highs, kind of in this range and this range, we're like, there's some shadows below here. Last week there was a candle pattern right there, kind of holding at support. So interesting to just kind of see that. Now, what I wanted to point out now is, where are the dividends at? Could this potentially fit into a ladder? There's more investigation we can do, but I want to just kind of highlight those that are structuring a ladder. That is in the month of July. So we've got a July now, and that would be Merck. Let's just assume that the trader investor is fine with this investment. Like I said, it is interesting because it may be one of the lowest PEG ratios actually in the S&P 500. At a 0.25, it's really, I mean, it's interesting. It's sort of getting into that range. Okay, let's look at another one too. So we've got Merck here. In fact, what I'm going to do is just pull this over here. We'll just keep tabs of it so we can kind of look at it here. So for our dividend ladder, we got first up Merck. Okay, and that pays, we're just looking at the most recent month, it's July. So what we're really looking at around there is maybe a June and an August as well. And once we have that, as long as the dividends keep getting paid, we should have built in here consistent dividend, referencing what we're after here. Now, I want to make a totally different step here into another area. I did build for you guys a way to track cash flow relative to prices. Now, it was a little bit unique. It took a little bit of time to do because we can look at cash flow per share is what we tracked. But to get a sense of historical cash flow, we talked about it last week, right? Cash flow is important. If you don't have cash flow, it's really difficult. I mean, okay, if you don't have cash flow growth, many companies obviously in S&P 500 have cash flow, but do they have it growing? Growing can mean keeping the dividend consistent and or raising the dividend they have done previously. Let's go full screen to kind of show you this. It is simply an indicator over here, and I will share this in the more section of under YouTube right when we're done. Okay, but I've got to name it. That's one reason I don't have it named yet. It's my new study number 4. By the way, you can always create these down here. I do create a number of different scripts and scans on the ThinkScript class on Friday if you're interested in this kind of information. But I'm going to go ahead and just add this in right now. It is step number 4. You can see there's a lot here I still need to work on, but I have adjusted it. Let me make sure I've got my, this is how I'm going to do this. I'm going to put the price to cash flow as a, well, let's go with a 3, a little bit thicker so we can see it. And then I put on here an SMA line. We'll keep that as a 1, but I want to make it black. And those will be the colors. Of course, you can always change the numbers just like I did when you get the script. Okay, now what this is going to do, I put it on here for us, and I'm really going to expand this up so you can really see it big. But what this taps into, you remember, we've talked about the importance of cash flow on these companies in terms of keeping that dividend payment going. We already know we use kind of a little bit of a estimate for it based on earnings using the PEG ratio, but scooting on down here a little bit, there it is. There's your cash flow. Anybody remember that? We actually went into detail on it last week because I remember JB we were looking at this, but there it is right here. So you've got your cash flow per share. Remember, from left to right, are we seeing the consistency at least? It might not be up, straight up, but is it consistent relatively speaking? Here's 6, we've down to 5, 7, 8, back down to 6 again. It's kind of sideways, that price to cash flow, cash flow per share. What we're doing here on this script is we're using it, just like the PE ratio tells us, what are we paying for the earnings per share in terms of price? This script gives us the price. Well, I've got to actually put my lines right to get this. Okay, price to cash flow. So it's our another value reference right there. Price relative to the cash flows of the company. We can see here that the cash flow, steady or stable. I mean, it's not going up. We could look for those that are going up, but we're looking at price to cash flow. Now, we did see that the dividend spiked on Merck. Merck has been up, longer term trend. Of course, this is a pretty big dip. Will it hold support here? We're looking at it in terms of a dividend ladder. Now, that's price. Let's look down here, and this is how we can kind of read this. So I've got some labels down here for us to kind of take a look at, but we're looking at the cash flow per share is what that stands for. This is the price to cash flow ratio, and that's the average. When we dip below the average, this could be construed as undervalued, okay, relative to the longer term trend. It currently is at a 7.6 price to cash flow. The PE ratio, I want to say, was 15. The price to cash flow per share ratio is like, well, it's like almost directly half of that, right? So do they have enough to continue to pay that dividend? There could be some further investigations, but from a value perspective, you can see that that would be a plus based on what we're seeing here. It had been higher before, now it's lower. It's back to actually, these levels here, which are really, kind of before the stock had really run up a lot. Anyways, a few thoughts on that. I'm going to share this again with you so you'll have this, and you can go back to. The nice thing about this indicator is, look at this 2-year, you got it. You can go back 2 years, and you can see where are we at, relatively speaking, over a longer term period. I mean, folks, knock yourself out. Go back even further, 5 years, which I think is a pretty good reference. Now, are the valuations higher than over here? They sure are. But you know what else is higher? The growth rate. We saw those growth rates really high. Okay. So prices go up when growth rates are higher, and this is just an interesting value read. What did this longer term kind of helps? We were above our average line for a long time, but right there could be construed as a undervalued level, specifically for those dividend stocks. Now, how many of you do like undervalued? It's based on this indicator, but I think if you I like undervalued. I mean, I think you have to buy relative, to what you think the stock has got, but the price is so important where you're buying it. It really is. You don't want to buy too high. Perhaps this was really quite a high range over here. I'm just pointing over here, and this was maybe a little bit higher price than where we're at now, resting on near these prior highs. So we'll share this. Let's continue, though. We've got a couple more to look at because we've got to build that dividend ladder. We still need a June and we need an August. And can we find those in our list over here? Well, let's look at the very top one here. We talked about energy in terms of a sector. It's showing some strength off the bottom. There you go. This is a 2.39% dividend yield. So it's above 2%, met our criteria. It has been increasing dividends. The 10-year growth rate is 2.33%. Estimated earnings growth in the high teens. Merck was 21% in terms of estimation. This is just about 0.5 under the PEG ratio. So it meets that parameter. Remember, there were only, out of the S&P 500 that paid dividends and met this other criteria, that had increased their dividends, there were only, 8 companies. It's a very, very small list of companies. It's not a guarantee that they'll go higher, but it has combinations of growth and value, as we mentioned. So let's look at BRK right now. Here we go. BKR. There's Baker Hughes right there. Okay, let's look at a long term on Baker Hughes, and we'll see that it has been extending higher. It looks like it did take out a recent high right here, just barely, but we came back down. Maybe, flagging up higher, we shall see. But importantly, when did it pay its last dividend? Let's pull it up right now and see. It happened in August. Guess what? We get to add this to our dividend ladder here. So this is BKR as an example, as a way to do it. Let's pay in August. There we go. Now we've got to find one that pays in June as well. By the way, the one we're going to be looking at in June is, I think it's the highest dividend payer in the S&P 500. It's got a little bit higher price to cash flow ratio. Look down here on this one. The price to cash flow is at 2.3. This one even has higher value, relatively speaking. What's the PE ratio at? BKR 17. So right in that range. But clearly, shooting off some cash flow. Let's pull it up right now. I've got it linked, so it's going to show up automatically here for us. Scooting on down, do you see consistency in those cash flows? Now, it was higher over here, and there was a dip. Folks, this is called the coronavirus market. And then it pops back up over here, here, and here. And this is really the second highest. It's getting back to the levels that we had at 2019. It's on its way. It's not there yet, but it's the second highest we've had. So more recently, it's been on an upward trajectory of growth for the cash flow. We can reference it now over here. Prices are a little bit above this line, but it's dipped down and still only in the 2.3% range. So historically, this number could be actually quite high. Let's check it out. Okay, so it's a little bit lower than where it's been, but that is our reference there. It's certainly got projected earnings tied to it. So we wanted to go through all of those features, okay? But yeah, consider using this if you like that price to cash flow. Again, I think it can be really helpful because we are looking at dividend paying stocks. Now, the last one, as I promised, I think it is one of the highest, if not the highest, on the S&P 500 in terms of dividend payers. Any guess on what it is? If anybody guesses this, all right, you might already know. This would be my guess too. I've got a couple companies. It's either Altria or it would be Altria or Verizon. And I'm actually looking for Verizon here. Let's pull this over here. Get it right over there. And all I'm going to do is simply click on it and click on it again. And there we go. So these guys don't pay dividends. We'll scoot on down until we do see some dividend payers in the 500. And there we go. So, it's actually, it's the third. So Walgreens, but this is a dividend trap. As we looked at, I looked at was either this class or maybe I think it was this class, but it's a dividend trap because that dividend is set to be cut on a 4-quarter basis. So that one right there, let's go ahead and just mark our red line in here, a dividend trap. I think that was in last week's discussion. If you want to check it out, it is there. Let's do this now. And here is VZ. So 6.5%. I mean, approximately right in that range. Really, actually quite high, the third highest in the S&P 500. But let's look at it. It does have some expected growth. Here is VZ right there. It has gone sideways in a longer term channel. Now, is that bullish? It could be. We're kind of towards the low. Well, we're sort of in the middle of the range, actually, not on the lower end at all. If I draw a line through there, right there, you'll see that some traders might wait for it to, break above here before they buy. But the dividend yield is really substantially high right now, is it not? That is a 5-year. Let's look at the cash flow, price to cash flow. You can see we're at 2.7. So when prices flatten out for a long period of time, but at the same time, the cash flow continues higher. The one thing I really do love about this metric here is we don't see cash flow anywhere on this chart, but cash flow has been, it appears to be holding flat or going up a little bit, because as prices went flat, hear me out on this, what's happened to this line down here? It's gone flat as well. Cash flows seem to be there. That could help to be supportive to a dividend. And with that, some traders, investors might be interested in looking at a longer term yield there. Okay. So that could be our next one. Now, what were we looking for over here? We have oh wait, did I not have a June? Did I have a June or a July? What was Merck? Merck was a July. Okay. Oh, you know what I was looking at? Let me tell you. Verizon, to get the dividend, I put June. What was I doing? Why did I say July? I'm throwing myself off. Folks, it's a June. There we go. It's right there. Boom. So we do have a July. And that July, let's just put them in order. Here's our VZ. And this is a July right there. So we have in a longer term chart, I'm going to borrow Merck here for just a second, but we do have a Merck payment here. We're looking at Merck. And then we have a VZ. And then lastly, we have a BKR. In terms of a dividend ladder, we're building into this. 1, 2, 3. And again, the rotation would be the expectation. And voila, there it is. Right over here. There's Merck again. Just like we'd shown earlier, that's your Merck, 77 cents. By the way, they had raised it. It looks like 1, 2, 3, 4. If they continue to raise it, it looks like they raise it in, the next one more month out, they might raise it. That might be the last month. So the next month would be December. If they do raise it, they might be on the verge. This might be our last one, and they'll raise it again. So there you go. Merck again, MRK. You can see it right there on the chart. But that does constitute a ladder of income, month to month to month, which would repeat in the future as long as those dividends repeat. All right, now let's see. Okay, looks like James helping us out here in the chat. Half book value lost. Yes, so there was that, but book value. Sim was looking at one that had a book value loss. That can change with the declines. There's no doubt, no matter what we're looking at here. When it comes to those dividend assessments, can be very, very helpful, though. This was the one that was really, undervalued in terms of this. And by the way, we might be getting that PEG ratio showing such a lower value because some of these have dipped. Question is, we did look at the sectors, and some of those sectors were strong. We'll have to remain, that kind of remains to be seen. Will the sectors help lift Merck higher? Sometimes traders like to buy on a big dip where it's holding these long-term support levels. Or, for example, technically speaking, we looked over here at VZ in a long-term range. They might like to be looking at with the expectation of prices ultimately breaking higher or not. Of course, they could be looking at exit levels when they do break below these lower points here. So just some considerations to keep in mind. All right. that is what we've got. Folks, if you get a chance, bottom right-hand corner of the screen, really easy to do. Just hit that subscribe button if you're not already subscribed. I think many of you are, recognize many of your names. It's great to see those of you returning back. Always love the questions, comments, any topic requests as well. Love to try to incorporate those. If you like today's presentation, you found something useful, hit that like button. Helps force that YouTube algorithm to keep this content coming up more frequently. I don't think, James, I didn't see it in the chat. I don't believe we got a survey. So don't have to do the survey. But on that, folks, it is great to have you here today, and hope you found that informative. Again, that script will be in the box real soon, right when we're done, right when this gets posted, so you can tap in to that Think script if you like this cash flow. I'm gonna talk a little bit more on Friday and another indicator as well in the Think script class. All right, everyone. Well, it was gotcha. Thanks. All right. Nice to be with you. And hey, we'll see you all next time.